see that even Jim Cramer is now mentioning that this could be the perfect time to buy gold. Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. And in today's show, you wouldn't believe who is now advocating the ownership of gold based on some of the COT chart readings, which we have been talking about plenty on the past show. And it's none other than Jim Cramer. We'll dig into that in a second, as well as all of the other economic news of the day that's coming your way. So to get started, couple days ago on CNBC, I was somewhat shocked to see that even Jim Cramer is now mentioning that this could be the perfect time to buy gold. Funny story, I used to walk past Jim Cramer on my way to my options post on the New York Stock Exchange. Never did meet him, but in either case, mentioning the charts as interpreted by the legendary Larry Williams suggests that the general public is giving up on gold en masse, and he thinks that makes it the perfect entry time to do some buying. That follows along the lines of what I've talked about. You've heard Dave Kranzler on the show talking about it. Certainly for those of you who follow Craig Hemke at TF Metals and Sprott, he's been doing some great analysis covering the recent reversal in the positioning, which basically the trend has been when the banks get flat or long, that's usually when the prices start to go up. When the speculators get extremely long and the banks are short, that has traditionally been when the price is on its way down. And you see, as the article mentions here, when speculators get too bullish on gold, it's often a sign that it's about to peak. Conversely, gold tends to be near a bottom when the small speculators get too bearish, or analogously, when the banks are getting long or even closer to flat. Varies a bit in gold versus silver. Gold, the banks are, we'll see, actually, I'll show you right now. Here is the gold COT. Here's one metric of it, the blues being the commercial here. So you see the lower this is, the more short the banks are. Has been coming in quite a bit over the past couple of months. Really since we saw that peak when gold broke through the $2,000 mark for only a day, I believe it was. You can see on that recent rally over the last week and a half, reversed a little bit with the banks getting a little bit more short. And we'll take a look at silver in a second, but one last note from Jim Cramer from the article. While this doesn't mean investors should always do the opposite of what small speculators are doing, this is a sign that gold could gain soon. That would be too glib, but he points out that in the last 9 years, whenever the net long position gold has been this low, the actual metal has rallied, and the best-selling points all came at moments when they had large long positions. So just interesting to see that in the mainstream and on CNBC. And again, something that we have been mentioning. There's the gold COT. Here is silver, which, as you see, there's been a substantial short position that, again, moves with the price here, getting pretty short. Price comes down. Let's see here. When they are less short, that was the beginning of a rally. And as you can see, the banks have been reducing their short position. Similar to the gold chart, short position did increase slightly over the past week while there was a rally. And we can take a look. Here is the silver COT report from the CFTC. Slightly different metric of measuring this, but you look at the swap dealers, call that the banks. And then the past week, they added 962 shorts, reduced 2,355 longs, so getting slightly more short. And here's the managed money, or the speculators. They were reducing short and long positions, but reducing about, let's call it 9,000 more shorts than long. So getting slightly more long, and we'll see how that plays out in the coming weeks, but matching what Jim Cramer was saying. Quick look at the silver ETFs, where we can see an SLV, 31.7 million ounces have come out of the trust over the sell-off. That's the 4-week change. So a lot of metal coming out of there. You see on the COMEX, 12.5 million ounces coming out of registered, which is what's available for delivery, and 8 million being added into the eligible. So that's a net still of negative 4.4 million ounces. And we can see that in the COMEX depository warehouse chart here. This is the registered silver stocks. Again, what's available for delivery. And you can see ever since that silver squeeze in about a year and a half ago in February, where you had 150 million ounces. So fair amount of metal coming out. You're down to 55.5 million ounces. Let's take a look at the 10-year chart. So you can see while it's getting low, there's still points in which it has been lower. See if we go back to the long term to put that into perspective. So this one going all the way back to 2002. So I don't know that I would say there's a run on the COMEX by any means, but certainly interesting to see how the metal is coming out of there. Also, hopefully you caught this already. Been meaning to comment on this. This was from about a week and a half ago. Another great article by Ronan Manly where he shows the LBMA silver inventories in London fall to a near 6-year low. And that's really been accelerating over the past couple months. Here he goes back to July, but as the article points out, seeing quite a bit of metal coming out of the London vaults. Of course, a lot of the silver that is stored there is on behalf of the ETFs. And in this article, which I'll put the link to in the description field below, certainly if you have not yet already read it, or even if you have, worth reading again. Here he mentions the LBMA vaults June of 2022 month-end silver inventories are now 182 million ounces, lower than a year ago. In other words, 15.48%, and a 14.82% drop over the 7 months from the end of November into June 2022. And also that of the 31 tons of silver that are claimed in the London vaults, 19,000 of those tons are already allocated to the ETFs, which leaves only 11,600 tons that was not held within the ETFs. Additionally, you also have to subtract out bullion vault and gold money that have some of their metal stored there. So interesting to see the trend. Something that I've been wondering is, where is this metal going? And Ronan suggests what my guess has been, and what I've heard from some other folks that I talk with, that you have a silver market deficit. So is some of this metal going to fill those outflows? Well, we don't know that for sure, but certainly seems at least plausible, and we'll keep an eye on that going forward. Another note regarding gold and silver, obviously we had the labor report come out on Friday, which was higher than expected at 512,000 jobs, which certainly would lead the Fed to be more aggressive on its interest rate hiking campaign. I know there's a lot of debate over the legitimacy of the government jobs figures. Here, Craig Hemke reported about how there was a 309,000 imaginary birth death adjustment jobs that was added in there. I'll put the link. He did an interview on the Corlin report where he breaks into the details of how that is derived. So if you want to know some of the specifics of why people feel that the labor numbers aren't the most accurate thing out there, that'll be in the description field below. Also, Rob Keynes did a half-hour podcast. He went through some of the data there and shared some of the discrepancies that he's found, with a lot suggesting that along with the labor participation number going down, that you have people taking on multiple jobs, which is not necessarily a sign of strength that people are getting better jobs, but some people taking on more than one job at a time. Interesting reaction in the gold and silver markets. Here you can see this was when the labor report came out, and gold dropping from above 1,800 down to 1,782. Not entirely unexpected, although there was quite a rebound. Similar pattern with silver, where let's call it 2010 down to 1950, and then rebounded to around 1980 as I'm recording this on Sunday night. See silver hanging in there at 1977. So given the number that did come out, regardless of one's feelings about it, if you're a gold and silver investor, probably about as good of a reaction in the metals as you could have hoped for. A couple quick notes here. Bank of England's Andrew Bailey warns UK faces a very big inflation shock, defends historic rate hike. They did raise 50 basis points last Thursday, taking borrowing costs to 1.75%. and Andrew Bailey pointing out what I guess most people have realized, that UK, as well as many other places, facing a big shock with UK inflation up at 13.3%, so even higher than the public numbers in the US. And I always find these interesting. The bank added that it expects inflation to remain at elevated levels through much of 2023 before falling towards its 2% target in 2025. The idea to me that the central bankers know inflation 3 years out, when we saw central bankers around the world talk about transitory, or they had it under control, as it has been soaring for the last year and remains high and quite a problem for many right now. Interesting, after that labor report, here's the FedWatch tool from the CME that backs out the Fed fund futures probabilities of the rate hikes going forward. And it looks like they're now calling it about 75% chance of another 75 basis point hike in the next meeting at September. This was a lot lower before Friday. And if we go over to the probabilities tab here, you can see market pricing in a chance of a rate cut, although now back out to July. This had been earlier, had seen this as early as May when we saw that blue, which is the highest probability of where things would come in. But certainly the market expecting a more aggressive Fed, and we've seen rate hikes from many of the different central banks. Of course, that is affecting the mortgage market. Here we see a shakeout among mortgage lenders, according to CEO of Santander Bank. Banks and other mortgage providers have been battered by plunging demand for loans this year, a consequence of Federal Reserve interest rate hikes, which is certainly one of the main factors why many have expected a Fed pivot, which I do expect, perhaps not as soon as some others. But see, mortgage business boomed during the first 2 years of the pandemic, driven by rock bottom financing costs, although that trend is reversing to some degree, and some of these financial institutions are cutting back. More recently, largest bank and home loans, JP Morgan Chase and Wells Fargo, have cut mortgage staffing levels to just to the lower volumes. Sector was as good as it gets, but they looked at returns through the cycle and saw where we were headed with higher interest rates, made the decision to exit. Article here on Wall Street Journal that we now see home sellers cutting prices as the housing market cools. It was interesting. Obviously, the home prices are still up year over year. And here, home prices are up about 44% over the past 2 years, which, in my opinion, has a lot to do with the quantitative easing packages out of the Fed. Although now with the Fed reversing course, you see as more homeowners weigh cutting prices, they face several different difficult decisions at once. They could need to cut prices once or even several times. Eventually, the seller may need to accept less than they feel the home is worth, or choose to take it off the market, try again when conditions improve. The days of bidding wars and homes selling for tens of thousands of dollars or over asking price are over, said Daryl Fairweather, chief economist at Redfin. So are seeing some impact. I wouldn't say it's a collapse in the mortgage market just yet, but the signs of some of these things are out there. One more note here in terms of the Fed policy and what they might do and the timeline they might do it. It was actually on Wall Street Silver, which was recorded last week and released on Sunday. So I'll put that link there in the description field as well. And finally, in wrapping up, would like to thank Blackrock Silver for bringing us today's video, and also mention that they recently announced a $5 million Canadian private placement set at a price of Canadian 50 cents per unit, and 1/2 of one common share purchase warrant, which will have an exercise price of 75 cents per unit. The proceeds will be used for continued exploration of their silver and gold project in Nevada, which, as I mentioned, they have expanded recently. We've had Andrew on here several times in the past year talking about the Tonopah West District, and back in July, they went 1 kilometer further out and found additional nice results. So good to see them expanding their resource area, and appreciate BlackRock bringing us today's video. Hope you're having a great day out there and your week's off to a good start. And in case you missed Rafi's latest weekly silver report last Friday, well, that one's coming your way now.